Hello and welcome to Options Guy TV. My name is Brian Overby. I am the author of the Options Playbook, and I'll be your host for about we're going to be short and sweet today, maybe 20 minutes on Options Guy TV here. On Wednesday, we let you know that earnings season is in full swing at this point in time. To me, earnings season always starts with JPMorgan's announcement. Also, Wells Fargo is announcing today just basically the financials. There's a lot of stocks that trickle in, but once the financials kick off, that usually means we're in full earnings season. And we had that happen today with JPMorgan. And JPMorgan has kind of brought the whole marketplace up, given some good news, basically very interesting to hear the financials after the 50 basis point rate cut by the Fed. So I think the financials are going to be, I don't know, just sway the markets a little bit because of everything that is around the big move by the Fed, going 50 basis points instead of 25. So in JP Morgan, we decided to get long. We were just going to do a very simple trade, basically take the time premium out of the option contracts, straddle where the stock was at, and say, well, if it goes up, we make money. If it goes down, we lose money. That's simple. That's straightforward. One-day trade. And when we went and put that trade on, and we can run to the Tradier Pro software at this point in time, JP Morgan was at 213.14. And if we look today, we see that JP Morgan is now up $9 on the underlying, or about 4%, which was about the expected move. The news came out, was positive, very solid earnings report, very solid. Well, so far in the conference call after the earnings report, said some good things. And we see that our long call spread that was only 5 points wide, we paid $2.65 for it to put the trade on, with the stock at 213.14, and now it's trading. Well, it's at one point it was at $5, but you're not going to get out for that. 4.97 would be great. You're probably going to have to give a nickel if you wanted to close it right now, and that would be fine. I would probably close the trade. We put the trade on. You don't want to go through exercise and assignment if you don't have to, because it just gets a little messy. So I'd give up a nickel and I would close this trade out, and we would make $2.30 on the trade, short and sweet. We limited our risk by doing the spread. We bought the 210 option contract, and we paid about $560 for that, and then we sold the 215, and it looks like we received around $285, somewhere in that range. And when we did that trade, we knew that when we woke up on Friday before the open and JP Morgan announced earnings, that there's a good probability that either the market went down around the expected move, and we lost the $2.65 that we paid for it, or $265 per 1-by-1 spread, or we made the $2.35 that would be on the upside if the stock went up above the 215 level. And we paid, and it did. So now we close that trade out and we move on with the trade. In XOM, we kind of were wishy-washy on Wednesday with our XOM position, but the stock is actually bouncing back, going at 123.60. So that's good news for the energy company. And, geopolitical concerns are going to play a big role. I expect the stock to be volatile. As a matter of fact, I even mentioned that if it got down to the 120 level, which is it was a real strong resistance to the upside going back for years, actually. But if you looked all the way back to the beginning of April, you'd see that right around that 120 level, the stock was below it forever and bumped up against it many times. And then the stock broke out, ran up to the 125 level. We tried to join in on that momentum, and the stock actually faltered a little bit, pulled back. Now it's going back up. So in that trade, if you stayed in, you still got a little bit of life. I would consider getting out, though, because it is Friday, and the weekend, there's always especially in October, there always seems to be news. And so if I hadn't closed that trade, I would get out of that trade at this point in time. We looked at doing a butterfly on Wednesday, and I didn't, a thing about rolling into it. I didn't really get excited about that butterfly, but we considered it. All right, so that's enough for the two trades from this week that we looked at. And like I said, it's earning season. I need to get like a confetti cannon or something. But if we did, we'd be all excited, ready to look at the earnings of next week. We have a boatload of financials. So let me pull it up here real quick. Netflix, Bank of America. Who else is in here that's interesting? 1 second. Let me take a quick peek. Interactive Brokers is also announcing. Johnson & Johnson is announcing. So we're going to be looking. We'll get to Monday. There's really not much that's going off on Monday. And then we'll look at a few more of these underlying stocks, a few more of the financials, and a few others. Johnson & Johnson is going to be an interesting one this time around. They always kind of are. See what's up with that stock. Okay, so that's what we got next week. So right now, the one stock that I always like to look for a stock to do a long call spread on, or a long put spread, but I think I'm going to get bullish on Disney. I think we're going to be doing a little bottom fishing here. Dare I say it. I don't want to go out and just buy stock, but when it's earnings season, as always with Options Guide TV and the Options Playbook, I like to try to find times where I would do all the different strategies, all 40 of the strategies that I lay out inside the Options Playbook. And the time spreads or the diagonal spreads are always most interesting to me around a known event. And so we know that Disney's going to be announcing earnings on November 14th. And if you look at the option chain inside the Options Pro, the Options Grid inside the Options Pro software, you will notice that if you look at the November 1st expiration, the implied volatility is 23%. And you go out to the November 15th expiration, you see implied volatility jumping to 35% and continuing on up. So obviously there's a known event, and that event is on November 14th. That's when the company is going to announce earnings. So that's a Thursday. This would be a Friday, 35 days away, with a long calendar spread. That means that you are buying the back month, the longer term option contract. If you buy an option contract, you want implied volatility to increase. So if I'm just buying options outright, I like to do it around an earnings event. And let's say I like the chart on Disney. I like the support, a support or a resistance level. And I was just going to buy an option contract. Well, I would probably buy the November 15th expiration, not because I want to be in Disney around earnings, just because I anticipate implied volatility will increase going into that earnings date. So it's at 35% implied. There'd be nothing to me to see it around 40 to 45% by the time you get ready to kick off that earnings report. So that helps out, right? If you're buying option contracts, you want implied volatility to go up. Now, if you're selling then on these option contracts, well, you're selling vol, but it's low vol. You're like, bro, well, why would I want to sell an implied volatility of 23 and buy one of 35? Well, the main reason is that this one is going to go up and this one's probably going to go down, right? Because the stock will maybe settle in, wait for the earnings report to get here. But the biggest thing is that the shorter term options always decay at a faster rate than the longer term option contracts. So in this instance, if we're looking to do a trade, we're going to focus on selling the short term option and buying the longer term option. And there'll be a chance for an adjustment because we got 35 days in this trade. So Disney is up today, 136. Would have been nice to do this yesterday, but no big deal. It's up 136 on the day, which is a good bit, a dollar, 1.45%, showing a little bit of strength in Disney just in general. We're going to look at the October 14th expiration, and I'm going to do something a little bit different. We're going to buy a more at the money option contract in November, pay up for it a little bit, but we're going to sell an out of the money option contract. So effectively, this would be a long call spread, but especially because the underlying market jumped today to up $1.34. Because of that, I am going to look at how do I say it? Because of that, I want to look at selling a different strike than we're buying. This would actually be a diagonal spread because we're going diagonally on the chart. We're going to sell the 97 strike and bring in 80 cents on that trade. And then we're going to jump out to the November 15th expiration, which I am not moving at this. There we go. And you could either go out and you could just buy the 100 strike, which would be a short vertical, but I want to buy the 95. Feeling a little bullish on Disney at this point in time. It's about time that the stock starts doing something. I think it's good for America if Disney does well in general. It's just kind of one of those things. It's Disney, for heaven's sakes. Let's put this one in. Oops, there. Then of course it jumped the gun on me. And this is a sell. Okay. So just moving a little bit slow on my internet. Okay. This is a long spread. I'm going to put it in the what if calculator, but it's really hard to discern what your upside is when you're dealing with two different expirations. But I like buying the 95 call here, which is fairly close to at the money, thinking that implied volatility is going to go up, and that's going to give us a little buffer on that long call. I do not want to be in this trade going into earnings. I'm going to go on the 14th, 14 days away, and I'm going to sell the 95 call, a 97 call. That means that if this was a long call spread, you'd have a 2-point wide long call spread. You'd buy the 95 with the same expiration, sell the 97 with the same expiration. We're going to mess this up a little bit, and we're going to be selling this 14-day option contract, October 25th, hoping that the underlying market gets close to 97. That's going to take 80 cents off of our option contract, right? If we go back to the 14, we see that that's trading for right around 80 cents. Well, 75 now. And if we do that, that lowers the price of our longer-term option contract. And there is no additional margin because we have the right to buy the stock at 95, obligation to sell it at 97. $3.30, that's going to be our maximum risk. Almost like if we just bought the call outright. Bought the call outright, that was fairly expensive, $400 and some odd dollars. 405, or we'll call it 410 at the midpoint if we got a midpoint fill on it. So $410 is what it would cost to buy that November 15th expiration option contract. And we're going to bring in 75 cents to offset that cost. All the focus is really on that 95 strike. We don't want the stock to go beyond 97 before the October 25th expiration date. And let's send it to the what if calculator, and we'll send this episode of Options Playbook out to YouTube, and we will be done for the day. But here's what it looks like. Okay, if I'm putting this trade on, don't expect a home run. That's not the way to approach this. I'm not going to put this on for 330 and sell it for 8 or 9. If you're doing it, you have limited risk by the way that you're doing the trade. You're taking advantage of a couple of things in the options marketplace. You're most of the time, like 99% of the time, as the earnings approaches, the implied volatility of the option contracts in that expiration right around that earnings has a tendency to creep upwards. So we got implied volatility on our side. Shorter term option that we're selling, time decay is usually faster on shorter term options than longer term options. Throw in the fact that implied volatility will probably stay stable or go down because it's not a part of the earnings. So I love time spreads. They're hard to get a handle on. This is actually a diagonal spread because we're not doing the exact same strike. But if we go and look at this trade, we have a lot of pricing components that are our friend. And that's not always the case in option trading. Most of the time, it's not the case. So time decay is our friend. Implied volatility is our friend. We're paying $3.30 for it. We don't have a ton of upside, and just note that. So it says if it gets to our strike at 97 in the short term, right now, if everything stayed the same, the what if calculator is implying a gain of 120. So realize that if this sells for $5, that's a good trade. If you want to make more of it on this trade and it hit 97, well, you'd have to roll it. You'd have to roll out another week in time, at which you can easily do on the trade if you would like to. You can even roll up and out, maybe go to a little bit higher strike, go from the 97 up to the 99 if that is available, if that strike is available. So it's not a home run trade, not a lot of risk to the downside. I mean, obviously, if the market goes down, the maximum is $3.30. And that's feasible. If the market goes down, you're going to lose money. You still got to be, the market's got to at least stay neutral or drift towards that 97 strike. And if there's any questions or comments, please let me know. I like time spreads around earnings and diagonal spreads. I keep saying time spread, but this is a diagonal spread. We'll take a peek at this, and this is a trade that we can trade. We're going to adjust it. We're going to watch this trade. We have 35 days. We're going to keep this one in the hopper, and we'll look at it definitely next week. And then also look at a few more trades in some of the financial stocks. Johnson & Johnson, as I mentioned, Netflix announcing earnings next week. So the old FANG, which you never hear of anymore, Netflix was a member of the FANG stocks. It's now about the Magnificent Seven and NVIDIA and all those other companies. So I feel like Netflix doesn't get it's the Rodney Dangerfield of the mega cap tech stocks. And it just doesn't get the respect that it deserves. All right. That's it for this episode of Options Guy TV. My name is Brian Overby. Come in Monday, 11 a.m. Eastern time. Share this with all your friends. We want to make this an open conversation, and do appreciate you stopping in, and we'll see you this Monday for the next edition of Options Guy TV.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.